Good afternoon, good morning, depending on the time zone that you might be tuning in from today. Welcome back to another session here at FinTech Nexus. I'm your host and moderator today, Todd Anderson, Chief Content Officer at FinTech Nexus. Before I turn it over to our esteemed group of panelists, just wanted to do a couple of quick announcements and some general information at the top. So first, our topic today, income verification and the future of lending. I want to thank Jessica and the team at Informed. Obviously, without partners and sponsors like Informed, we can't do not only these smaller, more intimate virtual events, but also the large scale in-person events. And Informed's been a long time partner and supporter. So thank you for the continued partnership. Second, thank you to the audience. Obviously, without a viewing audience, we can't do much of anything as well. So thank you for coming back, and we encourage your participation. So if at any point you have a question, 5 minutes, 10 minutes, 30 minutes, 40 minutes in, we encourage you to click the Q&A box, ask your question, and we'll go ahead and have those in a queue, and we'll try to get to all of them throughout our discussion. If for whatever reason you have troubleshooting issues, you need a phone number to call in, or you need a general question asked, if you can use the chat function for that. So Q&A for specific questions to our panelists, chat function for either general or troubleshooting questions. That way we can kind of focus those two areas for different reasons. And finally, before we get on to introductions, a couple of things coming up from FinTech Nexus. Next week in London, we have Merge. Merge is merging FinTech banking and Web3. If you haven't got tickets yet, you can still get them. Some are still left at fintechnexus.com. And then coming up at the end of the year in December, FinTech Nexus LATAM, which is covering all things FinTech in Latin America. And now we will get on to our show today and some introductions. So first, I will pass it to Jessica. Jessica, tell the audience a little bit about yourself and your role at Informed.
Thank you so much. I am so honored to be here. So thank you so much for having us all. I'm really excited to get into this. My name is Jessica Gonzalez. I am the Director of Lending Strategies at Informed.IQ, and my responsibility is really ensuring that our clients get the best use of Informed's products and return on their investments as quickly as possible.
All right. Thank you, Jessica. And Charles, tell us a little bit about you.
Yeah, hi, everyone. Also, I'm very grateful to be here. Excited to get into the topic. My name is Charles Whitaker. I'm the Chief Product Officer at Avant. Avant, for those of you who don't know, was founded in 2012. We're an online lending platform primarily focused on providing credit products, credit cards, personal loans to underserved middle class Americans. With the simple mission of empowering our customers to reach their goals with innovative solutions they need to move their financial lives forward. So I'm excited to dig into income verification and all things lending.
All right. Thank you, Charles. And Betty.
Hi, everyone. Betty Jotanovic. I'm the head of originations at Santander Consumer. We're an automotive finance company, and we operate under the brands of Chrysler Capital and Santander Consumer. And I'm really excited about our conversation today.
All right. Well, I want to kick it off with, and Betty, I'll stay with you at least to start with this question, and then Charles and Jessica, please feel free to chime in. So how does consumer credit profile vary when considering overstated versus understated income?
So there's definite differences depending on the credit profile. When adding a stipulation for proof of income in indirect auto lending, the higher your stip rate, the lower your capture rate is. So we have to take a surgical approach and be very pragmatic in terms of when we apply a proof of income stipulation, doing that only for the highest risk accounts. So typically what you'll find is in the subprime segment, there's more of an inclination to overstate income, typically due to a higher debt load, and that income may be needed to qualify. On the prime segment, you see the exact opposite, where not only is there an inclination to state true income, but there may even be understated income. A lot of times prime customers may be a little bit more savvy. They may feel that they don't want the auto finance manager to know how much money they make. So they may understate their income. So what we do is we take a risk-based approach and only stipulate based on those segments where we feel that there may be a need. And this may be not just FICO-based or based on the credit profile, but sometimes as we apply our fraud controls, we may see the fraud driving the increased income stipulation. But again, even with fraud, you see that higher propensity in the subprime segments.
Yeah, and I can hop in and add there. Am I up now, Todd?
Yeah, go for it.
Or is it going? Okay, great. I was just
No,
making
go for
sure. Yeah, I mean, so I agree with all that. Certainly, we see kind of a higher propensity for overstated or understated income based on credit profile or risk segmentation. I think one thing that's interesting that maybe isn't looked at quite as frequently or thought about as much is, how you ask a customer what channel they're coming from, how you ask them to report stated income can end up having a material impact on what income they actually report. And, oftentimes now with certain credit products, credit card loans where I've got most of my experience, that actual initial application or income reported could come from another channel where you don't control the capture of that information. So, especially these days where, multiple income streams, the gig economy are so prevalent. We also see differences in how people are reporting or understanding their income between net income, gross income, household, individual. There's a number of other reasons that can explain different pockets of customers that may have overstated or understated income. So really working customers outside of potentially bad actors or some of the other pieces related to credit that Betty mentioned, digging down and segmenting those to really figure something by the customer type and how that question is asked can be really interesting for your lending policies.
And I think to add to that, Inform's mission is to lower the cost of credit. And a part of that is also eliminating the bias. So I think a lot of lenders historically have not had all the data resources available. So income is one of the historically most difficult stipulations to verify, just because it's time consuming. There's so many different ways to do calculations of income. So being able to eliminate some of that bias or the way that we calculate it, understand what all of the fields are meaning, and also ensure accurate income calculation is really important to make sure that we're giving everyone access to transparent data, as well as being able to give everyone the best resources available to them, so that it's not so much focused on under calculating or over calculating, but just truly being transparent about the data.
As a reminder to the audience, I know there's been a bunch who've joined since I did my introduction there. If you have questions, don't be shy. Please feel free to put them in the Q&A box, and we'll go ahead and answer those questions as we continue to move through our conversation. I see a question came in, so please keep them coming. I did want to ask, and Charles, maybe I'll start with you on this. What obviously AI is kind of taken on more and more importance, especially the last few years as technologies have gotten better and more savvy. What are some of the obstacles that have prevented banks from adopting AI capabilities historically? I know that you have a background in banking and in fintech. What are some of your thoughts on that?
Yeah, so I mean, really a couple areas come to mind, and I will say over the past 10 years, I've definitely seen, Avant early on since 2013 has been using kind of machine learning models in underwriting and different policies. But I definitely have seen banks kind of dip their toes into this space and start using it more. I think some of the larger hurdles that have existed then and still do now, the first really is around the ability to understand model impact, not just the intent of the model and exactly how it will be used in any sort of decision tree, but then ongoing maintenance of the model, modern governance, both to explain that to your internal stakeholders, and then especially as well with regulators, and really how you can prove the impact that that's having to different segments of your customers. And the second largely has been around technology and data. And there's a little bit of a misconception that, all of the power here comes just in the actual AI models themselves. But, there's this data hierarchy of needs where ultimately that AI, those models that you end up using in production to make decisions or to guide decisions, really is just the tip of the iceberg, or kind of just one very small piece of the entire data science equation. You really have to put the right technology, data infrastructure, and process all the way from collection of data, collecting the right data, how you move and store and manage that data and those features, how you transfer, transform, aggregate data, optimize, govern it. So, you know, the bulk of that pyramid really is below there. And you've really got to, in order to get that value up top, you've got to make large investments starting at the very bottom. So in my experience, I think those have been two of the major obstacles.
And if I can add to that, I would say also just competing technology priorities. Even once you have all the models approved, gone through proper governance, and you have confidence in your models, just getting that technology prioritization. You know, if you're in a big bank environment, you may be competing with other lines of business. And so, you know, you have to maybe, you know, take a sideline to that. Or even, you know, in my current role where we do auto finance, that's what we do. So we're not competing against mortgage or card, such as in a bank environment, but there's other competing priorities, for example, controls enhancements or regulatory commitments. So I think that's something where, you know, from the business perspective, the sooner you identify the need and you can build your business case and get that prioritized, it may take time to get it implemented, but it's definitely worth the while.
I think those are great points, Betty. Whenever you're trying to share and leverage technology, I think it's important to have technology that's holistic in the approach and that's able to address multiple needs within multiple industries. And then in addition to that, make sure that it addresses the questions that are specific to your use case. I think that's a tall order, and historically banking's industry has kind of shied away depending on AI and really just said, you know what, this manual process may be time consuming and may add risk, but it's able to get it done. And we have those relationships. But in reality, when we're doing this shift and really with the COVID impact, and we're really focused on digital retailing and servicings, I think fintechs and banks have joined to create some complementary services that allow those digital enhancements. And I know that for Informed, really being able to partner and platform with like the F&I Sentinels of the world and bring in legal and compliance and get those objectives in addition to the verification and the speed of funding and increased capture really adds to the value of the package versus just looking at one product.
To our audience, I wanted to just this specific poll that I'm going to launch is really focused more towards the bankers in the audience. So please do answer the poll. We could take a look at the answers in just a few short minutes, but I'm going to launch a poll now, and we can come back to you know, some of the responses soon. I did, in terms of, you know, where our conversation's going and some of the questions that have come in. I see that we've had a few that are, you know, kind of in the same realm, and I'd like to get the panel's thought on this. You know, the question really is, you know, there are additional resources out there today that didn't exist before, you know, connecting directly into accounting platforms, potential databases, and income databases. Have some of these advances with various vendors that might be out there, have they made the process of verification of income better and more reliable? Versus maybe some of the more traditional methods of verifying income? Or do some of the same issues persist with some of these newer technology and newer platforms that might connect into accounting or directly into payroll and stuff like that?
So I could take a stab at that. So I think if you're, you know, referring to the APIs, the platforms where the consumer provides their logins and you download financial information, I think the challenge we've seen there, especially on the prime side, is that customers typically aren't willing to provide that information for an auto loan. I know banks are using that from a mortgage perspective. And everyone, I think, is accustomed to the mortgage process taking a lot longer. You know, the expectation is it will be a little more intrusive. It's full financial spreads. So what we're finding is when it comes to the U.S. indirect auto lending business, the prime consumers especially are just a little leery about providing that information as it's not customary. It's typically a stated income business. And so, asking for that information up front is a bit challenging. Then on the subprime side, we do use tools for income verification. I won't mention specific vendors. I'm not sure if I'm allowed to, but the problem there is the hit rate. So typically you'll see some of your big box retailers like, the Walmarts and Targets. So you will have some employers that pop up on the database and you can verify income. And the problem's really twofold. The hit rate's really low. So that's a challenge. And then the other piece is that sometimes you have multiple streams of income. So using that tool only satisfies one of the income streams, the W-2 income. So it's not perfect. It's definitely a tool. I would think of income verification in the auto business specifically. I would think of it as you have to have multiple tools in your toolbox. There may not be a one-hit approach. Some of it may be using these vendor tools, and the other is really relying on the customer or the dealer to provide the documentation, and then having the right process or technology to then verify that documentation that's been provided to you.
Yeah, the other piece I'd add onto that, certainly in the unsecured credit space, we've always put at Avant a emphasis on understanding, what hoops make sense for certain customer segments to jump through based on the product, the terms of that product, and people's general comfort with sensitive information, which of course pretty much everything related is considered pretty sensitive to most consumers, anyone included. So I think what we try and do is consistently test different vendors, whether they're back-end data providers that take documents from consumers and can add additional information, model scoring on top of that. And then really over the past few years, where I think we've seen the most movement and where I think we've been very interested is this customer permission data outside of just connecting your bank account, but connecting into HR payroll software. And with anything new, I think it takes a little time. So it's not accepted until it's accepted. But I think as more lenders are continuing to likely, and I guess we'll see the poll, but increase verification of income and employment over the next year or so, I do think people will over time get more comfortable with provisioning and a lender or a bank to actually access more of that information. And I think a lot of what the onus will be on the lenders is to think through that experience and be very clear and explicit with the customer about the intent of how they will use that data, what they specifically won't do with that data, because especially for gig workers and people with non-traditional W-2 incomes, it really can be a powerful tool to streamline the process.
Definitely, to just kind of add on, I think having that waterfall or that holistic approach whenever you're addressing income verification is really critical. Making sure that the customers that you're addressing, that if they don't expect to be stipulated, having several different product offerings. So with Informed, we have a skip the stick that's really focused on data, and not having to create that stipulation or request those documents when we don't feel like it's necessary to require those documents. But when it is necessary to require those documents, I think having a seamless experience from the customer perspective and enabling them to get those documents to you really quickly, you'd be able to verify them within seconds versus having a really delay in that process is really critical to making sure that that is a great experience for everyone, and really making sure that your capture rates are increasing over time versus having not such a great customer experience and people not wanting to do business again with you.
I'm not sure if you can see the results of our first poll. Are you focused more on income calculation and stipping as the economy appears to worsen? And this was more to our banker audience. It looks like 69% say yes, 31% say no. Any comments just on kind of some thoughts from the audience? We did have a few questions come in from the audience. The first one I'll ask is, does previous employment and income matter to your decisioning process? Betty or Charles?
So I can speak for the indirect auto business. For indirect auto, we don't look at previous income or time of employment. It's a very nuanced business, a little bit unique, but it's stated income at the point of application. And so typically we will look at several factors to determine if that customer is high risk and we would require proof of income. We would look at obviously their credit history and their FICO, but also do the trade lines on their bureau support the amount of loan that they're asking for. So if you've always, had a car loan for X dollars and now you're looking for something that's 3 or 4 times X, something may not seem right there. Now, certainly, it's not just looking at that one metric. We look at it together combined with the credit history and internal risk scores and payment patterns and those types of things. So in the indirect auto business, it's typically just your current income typically stated, unless there is a risk flag that would then require us to place a stipulation on that decision and then require documentary proof of income.
Yeah, I don't have a ton to add on that. I'm also not aware of it being super common to do actual verification of previous employment and income in kind of personal loan and credit card space. But certainly information, additional metadata about your employment, either your current job, how long you've been there, can be used in how we segment that risk and which different income verification stipulations or processes or mitigations we may ask you to jump through. So really just kind of one additional piece of information.
We had a question come in here, and Jessica, I'll point this one towards you. And this is obviously with the advent of the internet has probably become a huge issue, which is combating the fake pay stub issue. And I think if memory serves correct, there's hundreds, if not thousands, of potential sites that consumers can use these days. Talk a little bit about how you combat that.
Yes. So across all of our lenders, we see about 2.25% fraud rate from manually calculating fake pay stubs. So I think this is really great to identify because fake pay stubs is one of the first indicators that you're not going to be able to repay the loan because it is part of structuring the deal. And so I think from a perspective of making sure that our lenders are covered as well as our consumers are able to make those payments is really critical. So what we're looking at is we're using AI to look at fakepaystub.com, all of those, like you said, hundreds of thousands of websites, the Facebooks, the Instagrams, everywhere that is selling these digital enhanced fake pay stubs. We're able to look at them visually, understand the logos, understand what is missing from them if the calculations are incorrect. And we have a very high confidence rate that is fraudulent. So this is a really additional benefit to our lenders as well, because they're able to see trends and data in regards to they consider really fraud versus, hey, maybe this is fraud. You go into the rabbit hole, you're trying to understand maybe this is fraud and maybe this is another indicator. But when you're able to feel very confident that it's fraud, you start seeing additional trends. We've seen trends across image quality not being persistent. We'll see trends in regards to KYC as well as identity issues. And so that's why we feel really strongly that this is an added value to our lenders.
Question here from James in our audience. How do you use random sampling to improve your income verification? For example, testing a particular profile / set of checks to see how accurate it is based on a more complete audit. And if the profile checks score well based upon the random audits, then increasing the use of that profile. Betty or Charles?
I could take a stab at that. So in terms of random checks, in our indirect auto business, it's a bit difficult to verify income after the fact because typically we're relying on documentation from the consumer. But we do have a process where we'll hone in on certain segments of the portfolio based on performance or lack of performance. And then what we'll do is we'll use tools that are out there where we can verify income. But again, between a low hit rate and sometimes it may be just one portion of the income that we're verifying, it's not comprehensive. But what we do is we'll sometimes call the consumers after the fact and ask them to restate the amount that they put on their application. And again, here we're relying on the consumer to verify that. So without access to tools or documentation, it's really hard to verify it after the fact. So that's really used in our business just to hone in on certain segments of performance or where we suspect there may be some misrepresentation on behalf of the dealer. And that's where we use the customer provided information to verify.
Yeah, and to add to that, Informed utilizes a contributory database that we see millions of documents from, pay stubs to W-2. So not just focusing on one specific document type, but different document types, bank statements as well. And so when you're looking at so many different ways to get income and calculate income, we also have best in practices ways to calculate incomes based on those different document types. And so like Betty said, it is one of the most difficult things to do is calculate income before as well as after the fact. And so we're really making sure that when we look at these millions of documents that we have all of the data that we're really accurate. We also have an annotation team that goes in and does Q&A and sampling, just because we also want our lenders to have audit ready capabilities so that when you feel that audit comes or CFPB comes and says, hey, what are you doing? We're able to easily tell you these are the rules that we're doing. These are the rules based on this document type and provide that entry for you so that you're very confident on the income verification.
In terms of other fraud trends, I know we talked a bit about the pay stub issue. What are some of the other fraud trends related to income verification that that you're worried about, that you're trying to combat? And Charles, we haven't heard from you in a little bit, so we'll go to you, and then maybe we'll get some comments from Jessica and Betty.
Yeah, sure thing. So yeah, fraud trends at income ver is an interesting one. So it's certainly on the Avant side, we've seen, well, it's always been sophisticated, but increasingly sophisticated falsification of documents produced to verify income or employment. And I mean, I'm not an expert per se, but I mean, getting darn near human eye perfect. So of course, there's a lot of technology and providers, Informed included, that really focus on extracting alterations or comparing to known fraudulent documents that of course you should use. We also focus on trying to continually rely on other sources, of course, of income verification data from trusted parties. But the other piece that I'd mention on this that we really try and focus on a couple things. One is it can be dangerous if you segment the types of income verification strategies, like allowing documents to prove income purely based on a risk or credit segmentation of that customer. So what you also have to do is incorporate what we do is we incorporate all of our other fraud signals. So you have a more holistic view of how risky this customer is and how likely we think they are to be deceptive. So whether it's their device, any other models we have, any of the other information that doesn't quite smell right, we'll use that to dictate which income mitigation strategies or hurdles are actually available to that customer. And then lastly, I mean, the fraudsters working together move extremely quickly. So what we also put a major focus on is looking at constantly the velocity of the pass rates of all the different types of documents or forms or hoops that customers are asked to jump through to verify income, so that whenever we see a large change in that velocity, we're able to dig in and figure out what might be going on if we're seeing a trend of a certain type of bank or employer, et cetera, and making sure that we have that feedback loop in addition to the performance data for the loans or cards that get booked to quickly iterate and continue to test. So it's certainly something that we have our eye on, and our fraud team puts a lot of focus on at Avant.
Any other comments on fraud trends outside of the pay stub focus that we had a little bit a while ago from a question?
The only thing I'll add is fraud is an iterative process. Just as soon as you identify a trend and address it, the fraudsters get smarter. So it's the gift that keeps on giving, and you just have to keep improving your processes. And the more you can use automation and AI, the better.
I agree. The trends are just consistently changing. I would also say that whenever we're looking at the fraud trends, because we have that holistic approach, we try to address the root cause. So a lot of times you'll see, was this a person that was creating a fraudulent pay stub, but were they really trying to do the intent of being a bad actor? Meaning maybe they needed to create this fake pay stub, not that it's right or that it's allowed, but that because they couldn't provide proof of their income. So maybe they were DoorDash, or maybe they have a certain kind of income. Self-employment is often really difficult to provide verification. So really pushing back, as well as understanding the benchmark is critical within that segmentation, so that you can say, hey, maybe I should adjust my credit policy so that I'm making it inclusive to all individuals to be able to provide that verification. So maybe making sure that you accept bank statements. Certain credit unions historically have been not focused on bank statements or self-employment, and so that makes it a little bit more challenging for those individuals to get access to doing that verification. So making sure that you have not only bias within your credit policies and avoiding that bias, but also in the ways that you determine the income and the documents that you accept for income verification is critical. So that's why Informed also makes sure that we have not only, like I said, pay stubs and W-2 and the most military LES, and focused on some of those outliers so that we're giving equal access to income verification.
We had another question come in here, and is there a specific profile of customer that tend to show higher overstatement of income, whether it be specific job industry, geography, or application behavior that you've seen, at least in the customers that you serve?
I haven't seen it specifically in a job industry, but definitely it's skewed towards the subprime side where, obviously if your credit score is a little lower, you're currently already struggling to meet your obligations. There's more of an inclination to want to overstate, or even, it may not even be overstating. It may be, you're working overtime last month and you're just going to assume that overtime is going to continue.
Yeah.
So, may not always be overstated, maybe just a very ambitious assessment of your income situation. But I can't say that I've seen patterns in any industries.
And I'll add to that, from the data that we look at when we look at Bureau of Labor statistics data, as well as our contributory database and other data sources from third-party providers, we're able to see that there is trends in regards to industries, but they are changing so quickly that that is why some of our skip the step data is very reliable, because some data sources will provide that 6 months out, and so it's not as relevant if you're having insights into what is this data consistently within the past month, past 2 weeks, and being able to say that this is what the industry is. So not to give away the secret sauce, but there are industries that are more likely to overstate or understate, but it just really depends on the time of year, as well as like the business cycles within it.
It's an interesting one that just came in from Sebastian in our audience, which is, when you acquire new customers from marketing partners, would it reduce your anti-fraud / verification of income practices if the partner was able to implement checks on their end? And if so, what is the value of that pre-check? So essentially, if you're working with a partner and they're checking, does that impact how you, does it impact your fraud?
I mean, I can take that. I think it's certainly something that we have looked at, whether it's fraud specifically, fraud related third party may have about the customer. I think it can absolutely be orthogonal and used in how you assess the risk of that customer. Obviously, relying on policies and assessments that you don't have direct control over brings on additional risk as well. So as things change that somebody else controls, you have to ensure you have the right process on your side to understand the impact that has on your business. So I think it's one of those where, like, from a lending perspective, I think absolutely it's something that lenders should and would be interested in. The extent to which that information would actually be incorporated into decisioning or risk segmentation, I think would vary pretty significantly case by case.
I wanted to ask about bias. I think we've touched on it a little bit through our conversation here, but what verification bias do you see within financial services, and how can some of these biases be avoided? And this could be either self-employed or gig workers. Maybe Betty and Charles, I'd love to hear your thoughts on this one.
So in terms of, self-employed or gig workers, it's definitely more difficult to prove income. W-2 employees, a lot easier, typically one piece of paper or even multiple W-2s. When looking at tax returns, you may have understated cash income because of non-cash expenses like depreciation or amortization. So a lot of times we'll have to rely on bank statements, but then when you're relying on bank statements and looking at deposits, it's really difficult to distinguish earnings from other deposits. And so it definitely makes it challenging. So oftentimes lenders will look for a trend multiple months in a row. And again, it's still not perfect because you've got what could be other sources of deposits.
Yeah, the only piece I'll add on to there, I think, certainly multiple income stream income verification is just kind of by definition more complicated. How you weight different streams of income and the reliability of them to come up with really a composite view of someone's income or income stability is obviously more challenging than kind of a one-to-one situation. So there's certainly that. And I think having a plan for different types of income and employment types when you design and build your income verification infrastructure, decide which tools you'll use with which paths, how you'll manage that data, how you'll do operational training is really critical. And then, while I mentioned before, it's certainly a little bit earlier, but there are great companies out there that are specialized and focused on connecting in to get more of that gig economy type data directly into payroll providers that we have been experimenting with, which again, I think as customers continue to gain comfort and confidence in that, access to earned wages, et cetera, that can help simplify some of this process and reduce bias. But overall, regardless of that, you'll still need the ability to take multiple streams of data and assess them separately, but bring them together into one holistic picture, which is simpler than it is in practice.
Yeah, and I would just add that nobody goes into this business wanting bias, right? I think we were very adamant that we're trying to all do the right thing. But I think a lot of it is that you're not able to have access to that data. And like Betty said earlier, that income verification is just very difficult to do. We understand that. We understand that everyone kind of calculates it differently. They look at it differently. They're segmenting it and slicing and dicing it. But really being able to have access to all of the data in the documents is very important whenever you're looking at so many different types. And then being able to aggregate it so that you can have that composite view that Charles was talking about. I think that's really important to be able to say that this person has all of this different history versus just relying on a FICO score or just one source of income, and being able to give that holistic view.
One question that just came to mind, obviously we were focusing a little bit on gig workers there, is there's been a trend to move towards, either the earned wage access or giving people access to their pay at the end of the day or every other day. Do you see that potential trend, say in 5 or 10 years, where people are no longer the 2-week pay period is standard, it's switched up and people are getting paid every couple of days or every day they're taking their pay out? Do you see that as a more complicated potential process as a lender, or does it not matter in the grand scheme of things?
I can take a quick stab at that. I mean, I think the idea of how that's changing over time, I think it still has complication when you open that concept up of kind of earned wage access or moving beyond the being paid every 2 weeks or on a cadence of that time frame. I don't think it's much, it doesn't add a ton of complexity if you're, again, in kind of a one-to-one world where a worker has one income stream and looking for access to that and getting access to that earlier. But I think based on how things go, when you have a number of those in, there's an access to real-time information that's required, where I think these vendors will have to continue to push the envelope, because you really need to know at an exact given point in time how much wages have been earned, what's the status of the employment. And when you're doing that across multiple different income streams, there's still a challenge there to understand exactly the situation that the person's in, how stable that income is. So I think it's a very interesting space, and I do think that is a direction we'll see movement towards, over the next 5 years for sure. How exactly lenders will approach that, I guess we'll see.
And from a AI machine learning perspective, we're already extracting frequency as well as pay rate. So it doesn't add an additional layer of complexity. It's one of the additional forms. We expect forms to change. It's going to change all the time. New forms are coming, new laws and regulatory. But what is great about AI is that you can learn that really quickly and be able to incorporate it in a seamless manner.
Question that just came in: how often do you check your estimates of fraud rates in income verification, and how do you do so?
I can take that one. So we check our estimates of fraud rates significantly every month at least, but we have reports that are canned reports that come out on a daily basis. So we're always providing that. If we see a hiccup, we are always alerting our lenders so that they can be aware. We also have QBRs and making sure that we have those market analysis and benchmarking so that we can provide some real solid numbers so that you can see holistically where you fall within the industry that you're in. I think it's also critical that whenever we're looking at those fraud rates, because it's always changing, we do push out an enhancement at least once a quarter. And then we're also having a feedback loop, which I think is really key, because you have all these millions of contributory databases, but each lender usually has a fraud team as well. And so whenever they're able to look at items and identify fraud, we also take that back into consideration, that maybe it's not the fraud that we're looking at, but if they have said that this is true fraud, we take that into consideration and make sure that we have that clear feedback loop and make those enhancements additionally. And then when we push out an enhancement, we provide weekly reporting so that the lender can make sure that they have no false positives as well. We have a very low false positive rate. So that's, like I said, really reassuring to our lenders that what we're finding is true fraud versus saying that it's an indicator and then having to do some due diligence to determine whether it is fraud or not.
Yeah, from a lender's perspective, there's a few different ways that we do this, and one of them is in real time. Of course, there's monitoring in real time on actual documents that are marked as fraud, and you have alerts on that, and we review that, and if that goes beyond a threshold that we expect based on historical variance, obviously that kind of lights the fire, and we start digging in. But even ahead of that, that can take time and have a lag as well. So ahead of that, we're really focused on looking at pass rates. So for certain, are we all of a sudden just seeing the variance in the types of documents that are being uploaded by similar types of customers are changing? And is that in of itself worth digging into to go deeper on and see if something's going on? Are we seeing all of a sudden 80% of W-2s are 100% accurate? We're used to 60. All of those things that kind of can trip flags to kind of reassess and see if we need to be making changes or changing some of our policies. And then on an ongoing basis, of course, we have, experts that are reviewing accounts that have been booked or rejected and, really marking those certain accounts as fraud that we build models on. So that part's on a little bit more of a lag, but I think having a combination of real-time monitoring and alerting and then, curating specific data that you continue to build models on to get more predictive, I think that combo approach has been really successful.
We've had a few questions come along this a similar topic, which is and Betty, I'll start with you on this one, is when choosing an income verification provider or resource, what are some of the most important things that you look for?
So I think first and foremost is effectiveness. Typically when we're exploring whether it's fraud or income verification vendors, a lot of times we want to run a test and work with the vendor, and we'll give them some data and then see what they come back with and see how predictive it is and does it add value. Then it's ease of implementation. How quickly can we implement it? If it requires a lot of IT work on our side, That's typically a non-starter or it's going to be delayed. So the more flexible and nimble the solution is, the more the vendor's willing to work with us, the better. And then finally, cost. We need to make sure that, whatever solution, whatever value we're getting, that, that it offsets the cost. So, so again, effectiveness, ease of implementation, and cost.
Another question that came in here. In the subprime space, what percentage of customers are willing to provide pay stubs when required?
I can take that one. So in the indirect auto business, the challenge is not the customer providing the documentation, but the dealer. So in indirect lending, the dealer will send an application to multiple lenders, which is why it's really critical that we're applying proof of income stipulations only to the riskiest accounts and where it warrants it. Certainly, we're not going to try to win the business by taking on a risk, but a lot of people ask, why don't you just stip 100%? We know that the higher the propensity to stip, the lower capture rate. So it's really the dealer deciding. If I place a stipulation on a callback to a dealer, but my competitor doesn't, if the rates are somewhat close, the chances are the dealer's going to take the path of least resistance and go with the lender that doesn't provide a stipulation. So, what we're trying to do is balance and mitigate our risk, make sure that we're accurately assessing affordability, but at the same time, we're not being a little too overcautious in stipping where it's not necessary.
Yeah, I think that point, Betty, that you're making on, the adverse selection that you can incur in a lending business from, using a sledgehammer instead of a scalpel is really critical, and, largely probably applies across the credit spectrum. But that's certainly something we focus a lot on because, of course, if you stip everybody, the odds of your losses primarily being driven by people's inability to pay or affordability risk goes down. Your fraud probably goes down. But your overall profitability, your unit economics, your efficiency of spend on driving all those leads to the funnel, it doesn't take a whole lot of misused hurdles to impact large groups of customers that are your most profitable and best customers that can go elsewhere very quickly. So, one thing certainly we've done and have seen a lot of success with ourselves and with clients in the past is continuously testing holdout groups across different channels, different customer types. Not just on whether you're verifying income and employment or not, but how strenuous or how high the hurdle is you're asking them to jump through. Because what you'll see over time is as dynamics change, as other lenders' policies change, people's, this is a bad word to use, but verification of income elasticity or sensitivity does change over time. So you want to be able to have a test group there so you can really see what types of customers you're losing and kind of inform that unit economics formula that should be ultimately driving those decisions.
So when you were answering that last question there, Charles, I launched our second poll, which was, do you see a significant difference between stated income and actual income if you are validating income? I wanted to get the panel's thoughts on what our audience told us, which is 53% say no, they don't see a significant difference, and 47% said yes, they do see a significant difference. Any comments from the panel on what the audience is telling us?
I think that's pretty, on point, just depending on your segmentation, your portfolio, what niche you're involved in. So that's kind of the importance of understanding the segmentation and the data. So everybody wants to know how often somebody's going to understate or overstate the income, but it is particular in your area. It's even particular by lender. Certain lenders are more digital savvy, and so their fraud rate as well as some of their effects are a little bit higher. They're going to see an overstatement income because if you're utilizing digital documentation, you're more likely to overstate your income. So there's a lot of ways to slice and dice that, but I think that seems pretty realistic. Overall, we see about 41% wanting to understate their income, and so kind of even kill around those numbers.
Yeah, it's an interesting question and response because ultimately, if you could wave a wand and you were perfect at predicting who was overstating or understating their income, that poll would be skewed significantly towards, yes, everybody, like the income is changing, right? Because ideally, the more accurate you are at deciding who to verify income for manually, you should be doing that as much as possible for people where you don't have confidence that what they're reporting is what they make. So I think that's an interesting question to look at and to consider. And I agree, you'd have to really slice that, because for somebody that verifies income for 90+% of people in all channels, all products, et cetera, you're going to see probably closer to the numbers that we're seeing here or talking about here, kind of in it all. If you get a lot more sophisticated and you're able to predict the top 20% of people who are most likely reporting an incorrect income, whether that's higher or lower, you would expect the percentage of those people that you verify to have that change be much higher. So it's certainly interesting. And I think with that kind of number, you just have to be explicit and careful about what you're measuring towards and what you're trying to achieve.
And to add to that, in the indirect auto space, it's not as much of a problem. Not that overstating or understating is not a problem, but we don't see it because the dealer's the filter. So if we send back an approval contingent on providing proof of income, the dealer's going to make sure that the customer can prove that income before they're going to send us that contract. So I think that's where, we do see some variation, and it typically comes in terms of how do we calculate, do we include overtime or not? Self-employed, as we discussed, is always a challenge on how you calculate it. But typically, if there's a huge discrepancy and we stip that application for proof of income, the dealer is not going to let the customer drive off without that document. So we've got a little bit of a control there, if you will.
We just had a question come in from Jen in our audience. When using AI and technology such as Informed, have you typically seen lenders' funding time and efficiencies greatly improve? If so, by how much? And have dealers/customers seen a large difference?
Yeah, so really, we have seen a huge improvement. So if you're utilizing the dealer outreach tool that we provide, which is like a seamless white labeled experience, that you're getting those documents easier from a consumer and a dealer perspective, you can easily double your capture rate just because lenders don't have to kind of bother and they're doing those verifications up front. And it's a benefit for the dealers. If you're looking at it from a perspective of how much efficiency you're gaining from OpEx improvements, even small credit unions can save 1 to 2 days within fundings, and that's not even fully integrated with our API. That's leveraging our standing portal. If you are using a large volume, we can see about 20 to 30% straight through processing, depending on credit policies. 20 to 30% straight through processing with 10,000 loan documents over a month is a huge return. So we're talking about 1,000 ROI improvement. And sometimes people think, oh, that's not feasible. But when you're adding in increased revenue and capture, and then also looking at the avoiding fraud losses, and then on top of that, the operational efficiencies that we're seeing, just depends on volume. And whenever I address our lenders and customers, it's really about what is your low-hanging fruit, making sure that customers are receiving the ROI immediately. So if you have a large digital presence, then maybe we do a seamless white labeled experience where you're making sure that the customers can get the documents easier to us. If it is something that is, hey, we're always relationship driven and we want to make sure that we're only stipping when we need a stip, then they'll look at the skip the stip product. And so really focusing on what are the needs of the customers so that they can really see that improvement really quickly, and then also have the biggest ROI.
We did have, we still have a lot of questions here, which I'm sorry to the audience, we won't be able to get to them all. But we did have one come in from Stephen in our audience, which talks about reducing friction. Reducing friction is key with fast-moving fintech. Do you see MinFICO to bypass income verification? And if so, what levels are you commonly seeing this in the market?
I could take a stab at that and then I'll pass it over to my colleagues. I think MinFICO is not enough because it could be fraud. It could be mistaken identity or, identity theft. So I don't think that's enough. We use other fraud tools that help us determine. So certainly FICO is one factor, but it's not a knockout rule in and of itself.
Yeah, I think ultimately what this question gets at is what kind of are the best rule sets or scorecards you could come up, or models, obviously, that you could come up with to determine who you could skip verification for, or how to segment the risk or the need for income verification. FICO, I think historically that's been used. I think less so now. I think to Betty's point, just because someone's position on FICO spectrum doesn't necessarily mean that their problem you're offering them is going to be specifically with affordability. So certainly as a baseline, I think looking at the product the customer is requesting, looking at their payment to income ratios, DTI, what you can predict their income is, largely think of it as, how off would this person's income need to be for me to still be willing to give them a product with these terms is kind of an easy way to think of where it makes sense to verify income or not. So I think if you are going in, in a perfect environment and a super prime space for a person without a lot of debt, I think you can have a lot of success with a very simple scorecard to dictate this. But when you move into different channels, different products, larger exposure, I think you want to include a lot more different metrics there to determine who you can bypass income verification for.
Yeah, and like Charles and Betty said, I think just FICO is not enough, especially with the proposed changes to the Community Reinvestment Act, the shift of digital branchless banking, so many different factors, micro and macro factors that you really need to understand. So that I think that's why so many lenders are really relying on Inform's calculation of income at underwriting as well as in funding so that they can give the best leverage, detailed information there.
As we're coming up on time here, I think that's a good place to wrap. I want to thank obviously our panel for their great wisdom here today. Thank you to the audience. I think overall we had about 25 questions. So thank you for your participation, not only asking questions, but in our poll questions. Special thanks to Jessica and the team at Informed for your continued support and partnership. And obviously thank you to Betty and Charles for your time in speaking on this webinar. Until next time, always check out fintechnexus.com for more events, both virtual and in person coming up. Thank you to our panel again. Enjoy the rest of your day, everyone.
Yeah.
Thank you. Bye.
Thank you.